Major banks raise oil price forecasts. U.S. tariffs and OPEC Plus hikes impact outlook. In a bold move, major Wall Street banks have nudged their oil price forecasts higher for this year and next. However, the outlook remains uncertain due to lingering concerns over U.S. tariffs and rising output from OPEC Plus. A recent survey by the Wall Street Journal, which includes projections from powerhouses like Goldman Sachs, JPMorgan, and Morgan Stanley, reveals that Brent crude is now expected to average $67.14 per barrel this year, while West Texas Intermediate is projected at $63.68 per barrel. But here's where it gets controversial. These figures have only slightly increased from last month's survey, where the benchmarks were seen at $66.32 and $63.03 per barrel, respectively. This modest adjustment raises questions about the true impact of U.S. tariffs and OPEC Plus's production hikes on the global oil market. As the industry navigates these challenges, one thing is clear: the future of oil prices remains a topic of heated debate. What do you think? Are the banks being too cautious in their forecasts, or is there more to the story than meets the eye? OPEC to boost oil supply. What it means for oil stocks: BP, Shell, CVX. Imagine investing in oil stocks only to watch them plummet because of a cartel's decision. That's exactly what's happening with BP, Shell, and Chevron right now. The oil market is experiencing a significant downturn, and it's causing ripples in the world of investing. Oil stocks, particularly those of major players like BP, Shell, and Chevron, have taken a substantial hit following reports that OPEC, the influential oil cartel, is gearing up to increase production over the weekend. This move, which could potentially flood the market with more oil, is shaking investor confidence and causing a sharp decline in prices. But here's where it gets controversial. While this might seem like a straightforward case of supply and demand, there are deeper factors at play that could lead to even more dramatic changes in the oil market. U.S. light crude oil prices have dropped by over $1 per barrel, with Brent crude futures down 1.23% and U.S. West Texas Intermediate crude down 2.21% in early trading. BP, Shell, and Chevron have all seen their stock prices fall, with BP down 1%, Shell down 0.18%, and Chevron down 0.33% in early trading. The looming increase in production, which could be as much as 548,000 barrels per day, starting this Sunday, August 3rd, is not just a matter of simple economics. It raises questions about the sustainability of current oil prices and the long-term viability of investments in the oil sector. What do you think? Will this increase in production ultimately lead to lower prices, or will it spark a new round of volatility in the oil market? As we navigate these uncertain waters, it's crucial for investors to stay informed and adapt their strategies accordingly. If you're looking for the best oil stocks to buy now, consider using our TipRanks comparison tool to make data-driven decisions. And don't forget to share your thoughts in the comments. Do you agree with the potential for a price drop, or do you think the market will find a way to stabilize? Your insights could spark a valuable discussion. Oil prices dropped $2 BPL as OPEC Plus supply concerns and weak U.S. jobs data impact markets. Oil prices have dramatically dipped by $2 per barrel today, raising concerns over OPEC Plus supply and underwhelming U.S. employment figures. This development has left many investors uneasy about the future of oil demand. In a striking report from Houston, on August 1st, oil prices fell sharply, with Brent crude futures closing at $69.67 a barrel, representing a decrease of $2.03 or 2.83%. Similarly, U.S. West Texas Intermediate, WTI, crude finished at $67.33 a barrel, down by $1.93 or 2.79%. But here's where it gets controversial. Despite this drop, both Brent and WTI are poised to finish the week with gains. Brent up nearly 6% and WTI rising by 6.29%. This situation is compounded by discussions among OPEC members and allied producers, indicating a potential agreement may surface as early as this Sunday. to increase oil production by 548,000 barrels per day starting in September. However, not all sources agree, with one suggesting that the increase might instead be less significant. In tandem with these supply worries, the U.S. Labor Department reported a mere addition of 73,000 jobs in July, a number that falls short of economists' expectations. As a result, the national unemployment rate ticked up to 4.2% from 4.1%. According to Phil Flynn, a senior analyst at Price Futures Group, we can blame U.S. President Donald Trump with the tariffs, or we can blame the Federal Reserve for not raising interest rates. Flynn expressed that the Federal Reserve's decision to maintain current interest rates, which drew ire from Trump and several Republicans, was a miscalculation. Throughout the week, oil traders have remained focused on the impending impact of U.S. tariffs that are expected to take effect on numerous trading partners starting from next Friday. On August 1st, Trump signed an executive order imposing tariffs ranging between 10% and 41% on imports from a range of countries that did not secure trade agreements by his set deadline. These countries include major players like Canada, India, and Taiwan, while agreements were reached with the European Union, South Korea, Japan, and Great Britain. Suvro Sarkar of DBS Bank highlighted the importance of trade deals in driving oil market optimism, suggesting, "We think the resolution of trade deals to the satisfaction of the market has been a significant factor contributing to the recent bullishness in oil prices, adjusting for a few exceptions." Furthermore, the market's anxiety has been amplified by Trump's threats to impose 100% secondary tariffs on buyers of Russian crude as part of his efforts to persuade Russia to cease its military actions in Ukraine. These statements have raised red flags concerning potential disruptions to oil trading flows and the possible withdrawal of oil from the market. A report from JPMorgan on Thursday indicated that Trump's threats could jeopardize 2.75 million barrels per day of Russian seaborne oil exports, as both China and India stand as the second and third largest crude oil consumers globally, respectively. What's your take on the current oil market dynamics? Do you think these tariffs and OPEC Plus decisions will continue to shape oil prices in the long run? Share your thoughts, and let's discuss the implications of these economic trends.